Hello guys and welcome again to my channel. So we are already in the manufacturing part 2 video. So in the past video, we have talked about the journal entries, the unique journal entries of manufacturing entities. And I guess the highlight on that one is the accounting for the direct materials, direct labor, as well as the factory overhead, especially the accounting for factory overhead. And I promised you that whenever we have that journal entries already, then we're gonna go forward to the accounting cycle for manufacturing entities, right? However, I think in the past video, I have been lacking something. Everything is scattered, and I guess I need to review those things for a couple of minutes before we go to the next lessons, okay? So, as I've told you, again, I'm gonna do this because I think that everything in the past video has been scattered. That it's not really arranged. It's not good to jot down all those things. However, I think you understood already some things like the accounting for factory overhead because that's my main point in the last video. But then again, I have to review it for a couple of minutes. Okay? So first off, I told you that the manufacturing entities has three types of inventories. The first one would be the raw materials. The second one would be the partially completed or the work in process. And finally, we have the finished goods. So after these things, the raw materials has been converted into work in process or partially completed, and we have the finished goods, which is 100% complete. That inventories as assets will become part of the income statement because it will be converted into cost of goods sold. All right? But let's focus on the inventories. There are three inventories. And we have three main product costs. We have the direct materials, we have the direct labor, and the most important thing, which is the most unique item, is the applied factory overhead. Okay? And the definition of these things, like for example, the direct materials, those are the materials that are directly traceable in the finished product of the business. And we have the direct labor, which are the cost incurred for the people who are actually working directly to make the product, to make the finished product. And we have the factory overhead, which could be indirect materials, which could be indirect labor and other items, which are not directly traceable to the products themselves or the end product of our company, but it's very necessary for the production process. So I have given you examples of the factory overhead already. Alright? And I have also discussed about this applied factory overhead, in which since there are a lot of sources for factory overhead and it is very difficult to get them all together at the end of the month or at the end of the quarter, at the end of the period. So basically, if the company is producing some income statement or reports after 1 month or after a week or something like that, what will be used is the applied factory overhead, not the actual yet. Because again, in order to get the actual factory overhead, you need to analyze all the sources for factory overhead, and that usually happens only at year end or end of the period. Okay? So the applied factory overhead is actually based on your comparison with the direct labor and your actual factory overhead in the past periods. Okay? Which is why this applied factory overhead is usually based on the amounts of the direct labor. Like if the direct labor is 100%, 120% is factory overhead, or else if the direct labor is 5 pesos or 5 per hour times 100,000. So the factory overhead is about 4 per hour times the direct labor hour. So it's usually based on the direct labor. Okay? So even if these are considered coming from the past years, these are realistic estimates. Okay? So these are what do we call a standard or budget or expectation coming from the past experiences. Okay? But later on, this will be closed out. This will be uh, the analysis of factory overhead variance, actual versus this standard or estimated or expectation or budget based on the historical experience of the company. They will be analyzed and they will be closed out. Okay? So those are the three things that makes the manufacturing accounting a little bit different. It's very different. Not a little bit. It's very different from merchandising entity accounting. Okay? Now, after that, we've talked about journal entries for this one. Like for example, if we talk about raw materials purchases, raw material purchases, your entry will just be raw material purchases. If you wanted to follow the periodic inventory system. But if ever we pattern it to perpetual inventory system, you just have to debit raw materials. So I'm going to put here debit either raw material purchases or raw materials immediately. And then you have your accounts payable. If ever you have already established some relationship with some suppliers on this raw material, so you have accounts payable. And if ever you did not yet, you're just purchasing raw materials for cash, then credit cash. So that's raw material purchases. And then I talked to you about the issuance of raw materials, direct materials, basically. So to production, I told you that what will happen is you're going to debit it in another inventory, the work in process, and then you have to credit the raw materials because they stopped already being considered as raw materials because it's already placed into production. So from one inventory, stage one, which is being a raw material, it goes to the stage two, the work in process stage. And then I've also talked to you about issuance of indirect materials. Since we're not going to use the actual amount for the indirect materials, we cannot put that in the work in process account because we should, again, what do you call this, accumulate all the sources of this factory overhead because indirect materials is part of factory overhead. We have to accumulate them first at year end before using it to analyze the difference between the applied or the standard or the expected or the budget. You can call this, you can call applied factory overhead those or the plan. Okay, it's the plan because it's based on what's actually happening in the past period. So let's call that a plan, planned cost. Okay, now the planned cost or the applied factory overhead, we are going to compare it with the accumulated factory overhead later on at the end of the year. So on the issuance of indirect materials as part of the factory overhead here, we're not going to debit work in process. We're going to debit factory overhead control account, which is found in the operating expenses temporarily. But again, that will be closed at the end of the period. So factory overhead control, and then if that is indirect materials, so it's still part of the raw materials, for example, we have to credit it. Okay? So that's the difference. And then I told you about direct labor incurrence. So if you're gonna pay those people who are actually transforming the raw materials into the finished product, this is this. This is the transaction, direct labor incurrence. So what will happen? Instead of debiting salaries expense, because that's what we are taught in the past videos and in the past accounting lessons, salaries expense, salaries payable, here, we're going to have work in process. So your work in process inventory does not only include the direct materials that are issued to production, but also the direct labor that was incurred. So work in process. And then credit, if you wanted to, salaries payable, if you're not yet paying. But actually, if you wanted to be, you know, very much specific as to the direct labor incurrence, so aside from the salaries expense being substituted with the account work in process, and instead of just crediting salaries payable, you already know that there are a lot of credits here. Aside from salaries payable or accrued salaries, we have deductions for your regular employees like SSS, PhilHealth, Pag-ibig, something like that. So it's also applicable here. The only difference of that we learned, oh, actually I have a video on that, the payroll accounting, simple payroll accounting. So in there, we have salaries expense. We use salaries expense, and there are a lot of credits like SSS, PhilHealth, Pag-ibig, withholding tax before this salaries payable. So that is also still applicable here. But then again, let me remind you that instead of using salaries expense, we are just using work in process. Okay? I hope you remember that. So that's the direct labor. So there are already two things that were debited to the work in process account, which is the incurred direct labor and the direct materials that were issued to production. Okay? So that's it. Of course, the salaries payable will be paid, and then the deductions will be remitted. There is an employee share, there's an employer share. Just check out the video. I'll, this is the thumbnail. I look like I look like a fool, but I'll put the thumbnail here. Okay? Now, let's move forward. How about indirect labor? So in the indirect labor, incurrence, again, instead of debiting it in the work in process, since this is part of the factory overhead, and we need to accumulate all the factory overhead accounts, sources, amounts, and compare it at the end of the year with the applied factory overhead, it will be debited in the factory overhead control account, and then credit still, since both are still salaries by employees, although this factory overhead control are salaries of the employees that does not directly work to produce end product or finished goods from raw materials, like supervisors and etc. They are in here in the factory overhead control. Okay? Now, after that, I told you that the working process is not yet complete. It's not only the direct materials, it's not only the direct labor. We also have to put in there the applied factory overhead. Okay? So again, the applied factory overhead are the amounts, is coming from the amounts of the actual factory overhead last year's, and that is normally compared with the direct labor. So if you planned, that's a planned cost. In our minds, that is a planned cost. So the applied factory overhead or the planned factory overhead based on historical experience is already 110% or 120% of direct labor. You will have to make an entry of that, which is work in process again. And then the account applied factory overhead. That's it, right? And then, I talked about the adjustment at year end. And if I'm not mistaken, normally, the adjustment at year end is just, and if I'm not mistaken, I have had an illustration here, which is the planned cost or the applied factory overhead is 1 million. I don't know. Let's make other amounts. We have 1 million. And then the factory overhead control, for example, or the actual factory overhead is 1.2 million. So what will be the adjustment for that one? Of course, the factory overhead control will be credited because its normal balance is actually debit. And then we have to debit the applied factory overhead, which is 1 million. It was debited because the normal balance of the applied factory overhead here is credit. And then the debit could be cost of sales immediately of 200,000, something like that. That's option number one. I told you about that, right? So that's how you make an adjustment at year end based on this given cost of sales. Actually, guys, I have to add something in here, an information. Like, for example, what will happen if it's like that? The applied factory overhead is 1 million and the factory overhead control is 1.2 million. So that is what do we call in the books underapplied. So meaning your planned cost of 1 million was not followed. The actual is 1.2, which is not good, by the way. Because if you're planning a cost of only 1 million and on the actual you have 1.2 costs or expenses, then that is what do we call as unfavorable. So underapplied for me when I studied in college, I always think that underapplied is unfavorable. So that particular phrase, favorable, unfavorable, you are going to hear that usually in the higher topics of the cost accounting as well as in management accounting. So you have to really be familiarized with it already. So this is underapplied because the application is only 1 million, the actual is 1.2. This is unfavorable also. It's because you are planning to only have 1 million, but in the actual you have incurred a cost of 1.2 million. And again, the option 1 is to um, the difference will be offset to the cost of sales. How about option number 2? Option number 2 is stating that cost of sales should not be the only one that should be debited in that case. Cost of sales should not be the ones that should be adjusted in this case because cost of sales is actually an assignment of cost to those units that were sold. And if you analyze manufacturing entities, there could be units sold. There could be remaining inventories also, remaining finished goods, remaining work in process. Of course, raw materials is out of the question because raw materials is unconverted, 0% converted, so it should not be blamed with factory overhead. But basically, there are finished goods and work in process also. Aside from the units sold, aside from the units sold, we have finished goods that were unsold. We have work in process that are still to be finished. So what will happen in the option 2 is that aside from blaming it in the cost of sales, sometimes there is a debit to finished goods and there is a debit on work in process. And then again, you have to close the applied factory overhead and then factory overhead control. So how do you what do we call this, divide the difference? Like for example in this example, how do you divide the 200,000? You divide the 200,000 normally based on the equivalent units of these things, like the cost of sales. There are 100,000 units sold. So 100,000 units times 100%, 100,000. And the finished goods, there are 30,000. So 30,000 times 100%, 30,000. So it's now 130. The tricky part is on the work in progress because you have to convert the number of units for the work in progress times its conversion rate. Like for example, um, the work in progress is actually 50,000 units, 50% complete. So 50,000, you cannot use the 50,000 in the allocation. So because it's not 100% complete. So 50,000 times 50%, that's 25,000. So that is the ones that you're going to use. So 25,000 plus 50,000, 30. I don't know what I said on the finished goods. So for example, 25, 30, and then 100. If you sum them all up, that will become the denominator. The denominator, and then the numerator will be the 25, the 30, or 50. I didn't remember. The cost of sales is 100,000. That will be the numerator. So numerator over the sum of all of those times the 200,000, they are going to um, divide the difference between the applied and the factory overhead. Okay? So that's it. So because of this option 2, for example, the assets has the possibility of increasing and also the cost of sales. Because again, this example is underapplied. We have to add more cost because the actual is 1.2. Again, that's logical. It's because, again, you only applied 1 million. The recorded cost is only 1 million. Okay? Now, before we end this and we go to the next topic, and before we go to the 10 steps of the accounting cycle using these entries, the opposite of underapplied is overapplied, whereby if ever this applied factory overhead is 1.5 million and the actual factory overhead is only 1.2, that's actually a good thing. So over application is a little bit a good thing. Why? It's because you are planning to have a cost of 1.5, yet you have saved something because the actual is only 1.2. So that is favorable. Okay? So you have to remember that. Favorable, unfavorable. Okay? So that's it for our review. Let me check how many minutes did we have. Oh no, that's 22 minutes. So next, before we go to the accounting cycle for manufacturing entities, I would like to tell you that because of these things, because of this 6 here, and because of this, the manufacturing income statement is different from merchandising in terms of cost of sales. On the merchandising, it's very easy. Beginning merchandise inventory, plus net purchases, total goods available for sale. Of course, there are a lot of items in the net purchases like purchase returns and allowances, purchase discounts, and then freight in. It's all under here in order to get the total goods available for sale, and you less the ending merchandise inventory, and you're gonna have the cost of sales. It's easy as that. It's as easy. It's easy. It's easy like that. Or it's as easy like that. Right? On the manufacturing, the cost of sales is a little bit different. I guess if you compare this computation, this is just a computation for raw materials used in the direct materials used in the cost of sales for merchandising. For manufacturing. Now, here's how the cost of sales of manufacturing entities is computed. The first one, direct materials beginning. So you have to put the direct materials beginning. And then the net raw material purchases. Basically the same, right? There are also purchase returns for raw materials, purchase discounts for raw materials, as well as freight in. So very much the same. Raw materials available for use if you add them. Okay? Basically the same. In here, total goods available for sale. This is already available for sale immediately. Here, raw materials available for use, not yet ready for sale. And then you have raw materials ending. You have direct materials used. Actually, we're talking about direct materials here. Direct materials, direct materials available for use, direct materials. Yeah. So you have direct materials used. That's only one part. Okay? Because aside from the direct materials, again, you have also two other costs. So you have to add those two costs. Aside from the direct materials used, which we are thinking, logically, these are the direct materials issued for production. This one. Because if you analyze this one, you have your raw materials or direct materials that were not used in the past period, plus your direct material purchases now. So this is the maximum direct materials that you'll be able to use this this period. And then these are the unused at the end. So that means these are the ones used or issued to production. Okay? So we have to add, again, the direct labor. Because aside from the cost of direct materials plus the cost of direct labor, we have to add them because that is again the total main product cost. And aside from that, we have the applied factory overhead. So the applied factory overhead, I don't have to discuss this already. If these three are already present, I have already discussed this thoroughly in the last episode and now. The presence of these three actually is what do we call as total manufacturing cost or TMC, which is very, very, what do you call this? Literal. This is actually the total manufacturing cost, the direct materials, direct labor, and factory overhead. So if you have a manufacturing entity, those are the costs that you have to deal with. Okay? So this is in the form of money. Actually, the question here in the manufacturing is, if you have these costs, like 5 million, where does it go in the end? Does it go to the cost of goods sold? Cost of the unit sold? Does it go to the finished goods that were not yet sold? Does it go to the work in progress? Something like that. Okay? So that's the only question. Where does this go? The total manufacturing cost. Again, if these are the costs, like 5 million, where does it go? That's the only main question here. In the other topics also, like when we go to other topics of cost accounting, that is actually the real goal on the total manufacturing cost. Where does it go? Where should it go? Okay? Shall it be in the inventories or it's already in the cost of sales? Something like that. Okay? Now, before we go on, actually, these three, aside from being total manufacturing costs, uh, these two here, the direct labor and applied factory overhead, these are called conversion costs. And if ever these two are added, they are considered as prime cost or primary cost of the product, which is actually logical and very straightforward. Direct materials and direct labor are the primary cost of the product. These are considered as indirect cost, right? And of course, the direct labor and factory overhead are the ones considered conversion cost because they are the reason that the direct materials will be converted into finished product. Alright? So, that's the first part. This is the first part. This is the second one. Third, if there are total manufacturing costs like that, and you add them with the work in process beginning, basically these are the inventories that were unfinished last period. So this is also composed of direct materials, direct labor, and factory overhead in the past. Those were capitalized here. And actually, the sum of all of those is this one. So your total manufacturing cost now versus your total manufacturing cost related to work in process beginning in the past period, if you add them all up, that is what do we call as total goods placed in process. So those are the costs of the goods that you are going to finish. Okay? So these are the costs of your current work plus this one. So if you add them all up, I guess these are the total costs that you have to consider now. Because the work in process beginning, you have to finish that now. And of course, the total manufacturing cost now, if you wanted to, you could finish it now also. So those are the total cost of goods, total cost of goods placed in process. Okay? Now, of course, if you're not going to finish it, then you have to establish the work in process end, which are the direct materials again. It's composed of direct materials, direct labor, and applied factory overhead for the goods that are not finished at the end of the period. And the total, you have to put it right here. So meaning, the total goods placed in process, the total cost now, plus the cost of the beginning work in process, since it was not yet finished, so this one minus here is the cost of goods manufactured. Cost of the goods that are finished. Okay? So the unfinished plus these efforts that you have, that's why you incur the total manufacturing cost, the total goods placed in process. Okay? So since there is the unfinished, you have to deduct that in order to get the cost of goods manufactured or the finished goods during the current period. Okay? So the finished goods during the current period, you combine that with the finished goods that were unsold in the past periods. That is what we call total goods available for sale. Again, the finished now and the finished a while ago, finished in the past period, the total of that is total goods that you'll be able to sell. The maximum amount of units or the maximum cost of units that you can sell. Total goods available for sale. Okay? Somewhat like this. And then, of course, if you deduct the finished goods end here, again, the finished goods end right here is composed of direct materials, direct labor, and applied factory overhead for the goods that were not sold at the end of the year or at the end of the period. We have cost of sales. That is their difference on the computation of cost of sales. All other else in the income statement of merchandising and manufacturing are very much the same. So this is a little bit complicated. However, if you understand the connection of the accounts, you'll be you'll you'll be able to memorize this immediately by heart. Not just here, not just temporarily. Okay? So that's the computation of cost of sale. Now I wanted you to use this in an illustrative problem. So I'll make an illustrative problem right here. Okay? Maybe it's something like this. So you don't need the 10 steps of accounting cycle if you are going to be asked what is the cost of sales. You just need to have some given. Like for example, BBG company has some um, direct material purchases of 2 million for this current period, and then direct labor incurred is 1.5 million. Factory overhead applied is 120% of direct labor cost, and then direct materials inventory decreased by 100,000. Um, Work in process inventory increased by 80,000. Finished goods increased by 50,000. And then you'll be asked how much is the cost of sales for the period. Something like that. Actually, you don't need the 10 steps of accounting cycle to answer that question. Okay? So, for example, you are one of, for example, I make a, what do we call this? A company. A manufacturing company, if ever. And I wanted to test your capabilities as an employee because you're applying to me, something like that. And I have given you this. Can you compute for the cost of sales for the period? Using this information only. And then since you saw this video, of course you can. Right? So how do you do that? So let's just focus here. For example, if we talk about direct material purchases, you can put that right here immediately. The 2 million. And then the direct labor is 1.5 million. So here you have 1,500,000. Of course, the factory overhead applied is 120% of the direct labor. And the 20%, I guess, is 150, 10%. So 300,000. So that's 300,000 more than the direct labor. So 100%, 1.5 plus 20%, which is 300,000. We have here 1.8. Alright? Sir, there are actually three amounts that could be extracted from the given. How about these things? How do we implement that here? Actually, you can have any amount at all, so long as you are going to follow the conditions set here. Like for example, direct materials inventory is decreased by 100,000. So that means if the direct materials beginning is about 500,000, the direct materials end is actually 400. So did you follow the condition? Yes. From 500, it decreased to 400. Now you can already compute. Sir, what if we use other amounts, like not 500,000? Do we have the same answer? Yes, actually. Yes. Okay? But before that, let's compute first the direct materials used so that we can get the total manufacturing cost. So, 500 plus 2 million we have 2.5 million as the raw materials available for use. And then the direct materials end is 400. So that means the direct materials used is actually 2,100,000, something like that. And the total manufacturing cost is 2.1. Where is my calculator? Oh no. Okay. You have 2.1 for the direct materials used plus 1.5 plus 1.8 equals 5.4. Okay? So we have 5.4. That's it. You just have to put any amount. For example, I don't like 500,000, sir. I wanted 1 million. Okay. So 1 million plus 2 million, that's 3 million. Since the 1 million, according to here, is just decreased by 100,000, that means that is 900, right? So 3 million minus 900,000, that is 2.1 still. And still the same. Computation, 5.4 for the total manufacturing cost. Okay? So you don't have to be very nervous if ever you encounter these things like the materials inventory is decreased by 100. Okay? But there are some problems that are very kind because they're actually going to give you the amounts for the direct materials beginning and the direct materials end. But since I wanted you to prepare to higher levels of, what do you call this? Knowledge and analytical skills, let's have this. So, it's 5.4. How about work in process inventory? It's increased by 80,000. So, I'll use here 200. This is just an example. You can put any amount here, 300, 400. We don't care. It will still be the same as long as you follow the condition set. So if that is 200 and work process inventory is increased by 80,000, so that means this is 280,000. So 5.4 plus 200,000, the cost of your unfinished inventories in the past, you have 5.6. Total goods placed in process minus 280. 5,320,000. And then we have the finished goods. The finished goods is increased by 50. So I'm gonna put here 100 because I'm thinking of Baby G company has goods that are really marketable. It has high demand. So we have finished goods beginning. That means the finished goods last period that were unsold. It's only 100,000. And we have 5 for 20 as the total goods available for sale. And if the finished goods is increased by 50, so that means this is 150. So the cost of sales is 5 for 20 minus 150. That's 5,270,000. Okay? So that's it. So again, on this lesson, you have learned that the cost of sales computation of manufacturing is a little bit different. It's a little bit different only. Little bit different from the merchandising cost of sales and all other things in the income statement of manufacturing entities versus merchandising are the same already. Like on the operating expenses, it's still classified or subdivided into general and administrative and selling expenses and finance expenses and etc. And the processing actually for the accounting cycle, they are very much the same with the merchandising, except that there are these things. You have to account for these things. So that's it for this video. I'm gonna talk about something else later. Later, yeah. Let's have the accounting cycle for a very short problem, illustrative problem, so that you will see the process. And then I'd like to introduce you to the account analysis already because a little bit I am, what do you call this? I do not solve problems like this already. I use the accounts because it's more logical and easier for me. So maybe if it is easier for you uh, to have the T account analysis, I would just have to give you the option to choose that one. So I'm going to teach you the T account analysis before we go to the illustrative problem for the 10 steps of accounting cycle for manufacturing entities. Okay? So that's it for this video. If you learn, please click like, subscribe, and hit the notification bell and share this video to those who need it. Thank you. See you on the next one.